So tonight we are happy to welcome Cornerstone Bank for a talk on financial wellness.
Awesome. So thank you guys for coming. I'm Julia Westwell. I'm the market manager store in Southbridge.
And I'm Tony. I'm the customer relations manager right in that same office here in Southbridge.
So we are your local bank, local branches. I have some business cards right over here if you want to grab any either now or at the end of the presentation. We're planning on doing about 40 minutes of presenting and then opening it up after that if you have questions. So stop us if you do now, but if not, we'll just run right through the presentation and then you can say them at the end. All right, so I'm going to start with credit. I'll tell you a little bit about your credit score, why credit matters, how to build it, how to fix it, stuff like that. And then we'll turn it over to Tony. He'll do the second half, which is your debt to income ratio. So both parts of these impact your ability to get a loan, to get financing, both of those. So what is credit? Credit is money that you borrowed to pay for something. So it's essentially a loan that a creditor or a bank, any type of lender, gives you, and then you pay it back, usually with interest. There's good credit and bad credit. Good credit means that you've made your payments on time, you have a good history, you're a good borrower. Bad credit makes it really hard for you to borrow in the future. This usually means you've had some late payments or something like that. Maybe you have a collections account or two, and that can make it more difficult if you're going to borrow later on. Credit's important for a few reasons. The biggest one that I would actually say is over here, that it lets you make large purchases. So many times people don't have enough money to outright buy a house, a vehicle, something like that. But it also can be useful in an emergency. If you have something you need to pay for, let's say your boiler breaks and you don't have the cash right away to do it, you can take out a loan for it. It's also more convenient than carrying cash. You can stick your credit card right in your wallet. But the biggest thing is it can affect your ability to get employment, housing, and even your insurance. So employers nowadays and landlords nowadays, they will check your credit to see how likely you are to pay your loan back, to pay them on time. And then the 5 C's of credit decisioning. So we have a few over here. We'll start right at the top with capacity. So capacity assesses not just your debt to income ratio, but your capacity to pay the loan back, to pay the creditor back on time. Your capital is kind of like your level of seriousness. Do you have money in the bank already? Do you have a down payment for a house? Are you already saving up? Your collateral, many times loans have collateral where the item that you're trying to finance, let's say a car, if you don't pay on it, the lender can actually take it back from you. It basically insures the loan. Your character, we also call this your credit history. Your character is how likely you are, again, to pay everything back to them. It's your history of making payments on time, making payments in full. Your conditions are the factors like the interest rate, the amount of principal, the term that you take your loan out for, so how long you have to pay everything back to them. All 5 of these go into your credit score. They form that number that you get. Your FICO score is what it's normally called. We have types of loans. So we usually go over the first 2 here, the installment loans and the revolving loans. Those are the 2 loans that you're going to see most often. Your installment loans are typically a fixed loan. So you take out, let's say $5,000, we give it to you, you pay us back. It's a one-time transaction and then you make monthly payments on it. So your personal loans, your auto loans. Your revolving loans are loans that you can take out. Let's say you do $3,000 on a credit card, and as you pay them back, you can use them again. So you're paying principal, you're paying interest, and then once you pay that back, you can use that principal again. So your HELOCs and your credit cards are 2 of your big revolving loans that you'll see a lot, especially on credit reports. A HELOC is the equity in your house. You can actually borrow against it. So at Cornerstone, we do, our general one is up to 80% of the equity in your home. So we take the value of your house minus what you owe in your mortgage. So HELOC is home equity.
Yeah, home
equity, line of credit. All right, cost of credit. So credit is not free. If you want to borrow $5,000, you are also going to pay your lender back in order to borrow that money. The rates are different. This is where your credit makes a big impact. So let's say you're taking out a personal loan, and just for ease of numbers, we'll say that your rate is 12% APR, annual percentage rate. So your finance charge, which is the amount of interest that you'll be paying back, is going to be $600 on this loan. So even though you asked to borrow $5,000 and you're getting a chunk of $5,000, you're actually paying back $5,600. Now, if you have a higher score, you might have a lower rate. If you have a lower score, you might have a higher interest rate. So that can affect how much you're going to pay back on that credit that you use. And your credit score. So we'll kind of go into the other slide, but I just like this visual a lot. Credit is actually based, low credit is 300, high credit is 800 plus. We've seen it go as high as 850. Your credit score is kind of broken into chunks. So as you can see here, poor credit is usually between 300 and 579. You have fair credit between 580 and 669. Good credit starts at 670 and goes to 739. Very good credit is 740 and above. Excellent credit is 800 plus. Based on where you are with your credit score impacts the rates that you can get, as well as how good of a borrower you've shown that you are. So your credit score. It says about the same thing here, but with your smiley faces. We have, so usually what happens if you have poor credit, especially in these poor and fair credits, it's likely that you have collections accounts that went unpaid and the lender actually assumed all of the money that you didn't pay back for that. That does go against you for a period of time, especially if you still haven't paid them back. The good to very good credit typically means that you're usually good about paying your credit, paying your bills on time. Maybe you've made a late payment, maybe you've made a short payment, you didn't quite have enough that month. That will go against you a little bit and drop your score. Your score can also drop if you apply for new credit or if you pay off an existing loan, because your history and your usage also gets taken into account for this. Excellent credit basically shows that you have paid on time, you've made your payments in full, you're a good borrower, and you're likely to get those lower rates because your credit score shows that you've had a good history of paying back your loans on time.
Did I just hear you say that paying off a loan will actually hurt your credit?
Correct. So
That's
paying off,
completely unfair.
yes, yes it is. So the credit bureaus really like to see that you can use credit responsibly, but you don't necessarily need to use credit. So you take out a credit card and maybe you use it for things like gas. If you close it, it can actually hurt your score because it means it's one less line of credit that you can show that you have and you're using responsibly.
Yeah. And also, typically, one of the first items that you may take out, let's just say you took out your first credit card in 1997 and
Yeah.
you closed that card out and that was your first trade line. You know, you're basically taking a part of your credit history away. So you're
Yeah.
determining your overall credit history and length. So if you close that, it's going to change that length.
I have a question. What if one bank buys out another or acquires another, and you have an existing credit card with that bank that was just taken over? What happens?
It totally depends on how they've taken it over, but most times if you've signed a contract, they can't actually change your terms.
But they can change the account number, they can change everything, literally.
They
The
could.
APR, they can change whatever they
It
want.
depends on the contract that you had with the prior bank.
So read the fine print is what you're saying.
Yes, read
Yes.
the fine print before you sign anything. Absolutely. All right, so we've talked a little bit why your credit is important, but essentially your credit's important because it's hard to get a house. It's hard to even get a job now with a lower credit score. It's hard to get insurance. Even like I said, your landlords are going to check your credit most times because they want to see that if they put you in one of their rental units, you're going to pay them on time. You're going to allow them to make money off of you. So your credit score, it evaluates the risk of lending you the money. How likely are they to get their money back? Do you have a good history of paying them back? Do you have a poor history of paying your lenders back? It also affects the credit you receive. It can affect your credit terms. It can even affect your required down payment on a house. If you're trying to purchase something and you don't have good credit, they might require you to put more money down, right? So that you have less to pay them back in the future. So most times the loans are structured so you're paying more interest up front and more principal later on. Yep. Your lenders like to ensure that they're going to be paid. So that's the difference, I guess, between your lenders and your credit bureaus.
Yeah.
So your lenders do want you to pay them back, of course. So your credit bureaus, it's not that they don't want you to pay off the loan, it's that they want to ensure that you have a comprehensive history, that you have multiple types of loan, that you have multiple balances on your loan. If you have a bunch of loans that are either paid off or you have no credit cards at all, if you have credit cards with zero balances that you're not using, they really can't accurately determine your credit history because you're not using it. So that's why it can negatively impact you.
Okay.
Yeah. So tips for good credit, tips to either build your credit or continue having good credit history. Pay your bills either on time or early. Make sure that they're paid off in full. If you're paying the minimum monthly owed, especially on a credit card now, you can get yourself into some hot water. So does anyone know roughly what an interest rate on a credit card is right now?
20%, 21?
Minimum.
The one I just saw was 34.
No, you can't. That's illegal.
Yeah.
Well,
Anything
So-
over 30% is loan sharking.
Yeah.
That's illegal.
So they do, depending on your credit history and credit score, they can raise those interest rates, okay? Typically a lot of them are in the 20s right now. Yep. I believe the one I have right now is at 26%. So you are paying a lot back just by using that credit card. If you're paying the minimum monthly owed, that interest rate will eat you up.
Yeah.
If you're paying more than that and you're paying it off all the time, that's not only going to help you and your lending, but it's going to show that you can use it responsibly.
Excellent.
Yeah, so student loans, that's been big, especially in national news lately with the lenders. Some of them have gotten in a lot of trouble for that. But I have heard that happen before, especially where the rates are just so high that people can't meet their minimum payments. And a lot of times these student loans, you're taking them out at 18 years old. I mean, you're taking them out before you even fully understand what you're doing.
Oh, sure.
My loans I took out at 18, you know.
You probably got 5% though.
I actually do, yeah, I have 5% on those loans.
Yeah. So
Yeah, right
that's
around there.
fixed. That's not gonna go up.
Correct. My student loans are fixed. I have some privates and some federal loans.
Mm.
Yeah. So, and that's another one. Don't borrow more than you can afford. This seems like a funny one because when you're applying for a loan, and Tony will talk about this after, we look at your debt to income ratio. We look at what you get in every month versus what your expenses are. You would think that as the lender, we're making sure that you can meet your payments, but that's not the case all the time. I mean, think about everything that you pay monthly that's not going to show up on your credit report, right? Those things also affect this as well. So some of that you have to take into account. You know, if you have children, I have horses. My horses cost me some money too. So stuff like that won't show up on your credit, but it is a monthly expense that you want to take into consideration before you get a loan. So borrowing what you can afford versus more than you can afford is really important here. Limit the number of credit cards you have. So we talked a little about installment versus revolving loans. For good credit, you'd like to show both of them. You want a variety in your credit history. You want to show that, yes, you can take a loan of some money and pay it back in installments, but you can also be, you know, trusted with a credit card and to pay back that on time and in full. But you don't want to have 6 or 7 credit cards. And the reason is because you don't really need them, you know. You're showing that you're taking out a lot of money, but you're not even using them necessarily. You might use 2 to 3 of those cards. So some of them sit with 0 balances, or some of them might be maxed out, you know, and that can hurt you as well. So keeping it to a minimum, I would say 2 to 3 is perfect. Some of them have different rewards that you can use, so people like to use credit cards for that. Some have cash back, some have mileage on them, but limit the number that you have. A big one that I like to recommend to people as well is never co-sign and allow someone to use your good credit. Banks will sometimes ask for a co-signer if you don't meet the loan qualifications by yourself. The risk of doing this is that when you co-sign on a loan, you are equally responsible for that debt. So if the person that you're co-signing for defaults on that loan, if they're late, if they don't pay it, that reflects on your credit report as well. So you have to be really careful who you're signing things for and what they're taking out. And then review your credit reports annually. They are free to obtain once a year from annualcreditreport.com. You won't get a score from them, but you will get all 3 bureaus. All of them will pull, and you can see what's on your credit. And I do suggest this because they'll show if you have late payments, they'll show collections accounts, they'll show, let's say you had identity theft that you didn't know about and someone tried to apply for a loan in your name, you'll know if you look at these. And then you can dispute them in a timely manner before you actually have to use your credit for something. And then my rule of thumb and a general rule of thumb is the 30% rule. So don't use more than 30% of the credit allotted to you on your revolving loans. If you have 3 credit cards and you have a limit of $5,000 on each, don't use more than $5,000 total. And then on each credit card, don't use more than about $1,500. Okay, and if you stay under that 30%, it is showing that you have good credit usage, you're paying it back on time, you're not using more than you need to. We all get into situations where we have to rely on our credit cards. You know, we put something on it. As long as you're paying it back timely and making those minimum payments, you'll be golden. It's just not something that we should be doing all of the time. So how to build credit. We don't really want to start off with 0 for a credit score or no credit score at all, especially now in this day and age. A lot of people that are turning 18, they actually have credit scores already. One of the easiest ways to do this is becoming an authorized user. So parents can actually set their children up as authorized users on credit cards before they turn 18. And good credit usage on the parent's part will play a role in the child's credit score as well. So you can open a credit card or a loan and put them on as an authorized user. You can also open a secured credit card or a loan. A secured credit card uses your own money. So you can put $300 of your own money on it, and then you can pay it off just like you would a regular
So
one.
what's the difference between a secured credit card and a debit card? Why would you want to do that?
A secured credit card allows you to draw off of it and pay it back in installments. So whereas a debit card comes directly out of your account, your credit card allows you to show that you can use that credit and pay it off in a timely manner.
It's typically collateralized. So, for example, we offer credit cards through Elon Financial. So you would send them $500, for example. They would hold on to those funds, and they would give you then a credit card with a $500 limit, basically.
But
Yeah.
that's essentially what you're doing with a debit card. Is you have the
It
same
is.
amount,
Yes.
It is, but
and you don't have to worry about paying any interest on it because it's
Correct.
your money.
Correct, but it doesn't help build your credit. Getting a cosigner can also help you build your credit. So if you don't qualify by yourself, either for low credit or no credit, you can add a cosigner with good credit onto a loan. And then as long as you and your cosigner are making good on-time payments, that can raise your score as well. We'll skip don't apply for too many cards at once. We've talked a little bit about that. Maintaining a solid payment history as well and spending responsibly. Your cosigner has to be trustworthy.
Yes.
Yep. So a lot of times parents might co-sign for their children, they might co-sign for their spouse, but you need to know who's co-signing with you and be okay with the fact that that will become your debt if they don't pay it off.
It's almost like,
Yeah.
would you trust a friend? Again, friendships in these type of relationships could be severed
Yes.
if that person isn't really that trustworthy.
Right.
But you can probably trust your parent and vice versa.
Right. It's all about knowing that cosigner and being okay with assuming that debt if they're not paying it.
Exactly.
And then, of course, keeping an eye on your account and your credit report, making sure that all of the transactions that are on that credit card are ones that you did. If you see any transactions either on a credit card or even a debit card like we talked about that are not yours, you can dispute them with your bank or with your credit lender. They'll look into it and they can credit you back for those.
I have a question. If you decide to freeze your credit, how is that shown on the credit report?
So you have to get a code to pull the credit report. So if you decide to freeze your credit and then you apply for a loan through us, you would have to give us a code that we would then type in, and that would allow us to pull your credit.
And how does that affect the credit over time?
Having a freeze on it,
Yeah?
it really doesn't affect your credit. It's just a safeguard. It won't change anything, but it would make it a lot harder for somebody to take out a loan in your name because they would have to contact you in order to get that PIN number that they type in.
Okay.
So if you receive a call that says, hey, I need your PIN number, and you didn't take out that loan, that would be a really fast way to catch fraud.
Yeah, right.
Yeah. I wouldn't say there's any drawbacks to putting a freeze on your
It's a
credit.
safety measure.
I just found out about it a few months ago, actually. Someone gave a fraud, it was like a lecture at the senior center.
Yeah,
And I didn't even know that was a thing.
it is a thing.
I guess it's becoming more and more common. People
Yeah.
are doing it more frequently.
They are, and we recommend that if you ever have your identity compromised, we were talking a little bit earlier about places that get hacked and your identity is compromised. We do recommend putting a freeze on your credit. You can do it without having that happen too, but at least that way, if you already know that someone has your social security number or any of your personal information, it makes it that much harder for them to steal it and get a loan in your name. If you want to do that, if you're interested in it, you can call any of the credit bureaus. You can call all 3 of them and you can ask them to place a credit freeze. It's actually a pretty simple process. You could also do it online.
Once that card is paid off, and it goes down to even to a zero balance, or to 100 or something, how much time has to pass before it appears on the credit report?
We usually see it within the month or
Within
two,
a
I would
month,
say.
approximately, yeah.
Within the next payment cycle,
Yeah.
Okay.
I would say.
It may lag behind, but it's typically around a month,
Yeah.
a couple of months.
Yeah.
And on the flip side, how long does it take for a negative thing on your credit report to drop off?
So it depends a little bit on what that negative thing is. Inquiries are one of the biggest ones. If you're looking for a home or a car and you're rate shopping, they recommend you do all of your rate shopping in a 2-week period, because if you're doing it in a 2-week period, it only negatively affects you one time. If you rate shop over 6 months, it'll negatively affect you for a lot longer. So those can take maybe 2, maybe 3 months to raise your score back up again after you have credit inquiries. Something like a collections account, that will go against you usually until it's paid off. In some instances, people file bankruptcy, things like that. That could take months, if not years.
That's costly.
And it's costly, absolutely.
Now, when you do declare bankruptcy, does that reset the timer to 0, or does that just give you you get a whole new identity? How does that all work?
That's a fantastic question for a bankruptcy lawyer. It totally, it
I have them on
depends.
speed dial. So
I know. It depends on what chapter you file.
Okay.
Yeah, and what debts you're getting rid of or you're looking to bring down to 0. I will say that as, lending institutions, we do ask if you filed within the last 7 to 10 years. It is something that we make note of, and it does typically show on your credit report for a period of time.
Okay.
All right, I'm going to turn it over.
Thank you, Julia. So now we are going to discuss debt to income ratio. So debt to income ratio, that plays an important part in overall your understanding and your financial health, and your overall financial wellness. DTI can help you better understand your relationship to your debt and whether applying for credit is basically right for you. DTI is a metric that lenders look at when you do apply for credit, and they're basically assessing the overall risk to the borrower, and they're looking at, if we do take on this borrower, is it a risky borrower to us, the institution? So how do you go about in calculating your debt to income ratio? So in step 1, you want to add up your monthly debt obligations, and that could be anything from credit card bills, credit cards that you have, your monthly obligations there, miscellaneous installment loans such as personal loans, what your current rent is, so what is your monthly rent, what is your mortgage that you pay monthly, monthly child support or alimony. You're basically going to add up all those up along with any other debts. So how about student loans, auto loans that you may have. Then what you're going to do in step 2 is you're going to divide that by your total gross monthly income. So your income before taxes. And when you get a figure, you're getting your actual DTI, and that figure is in a form of a percentage. And lenders look at that DTI and determine whether you're a risky borrower or not.
So what's a good percentage?
So each institution, it really depends, has what's called a risk tolerance. So for us, when somebody applies for a personal loan, we want to have your debt to income ratio under 45% typically. So that is our institution's risk tolerance. And remember, when you're kind of even close to that, when we calculate your debt to income ratio, we're not also calculating other expenses such as your utilities. We're not calculating your payments for gas. We're not calculating the taxes you have to pay yearly. So that's something to keep in mind. So if you're at home trying to calculate this stuff yourself, you know, you got to think about the everyday expenses, food, right? If you pay, you know, to take care of a child, you're buying diapers, X, Y, Z. So if you're getting close to that mark, always consider to have savings, right, as a backup to pay for emergencies. So, you know, always keep that in mind.
You could take an average.
Yeah.
You could take an average of your payments and say, you know, if you do 50 this month and 100 the next month, your average is 75, and then know in the back of your head that you could either have more income or less income.
Yeah, that's faster, isn't it?
Yeah.
So trying to build that savings is really important. So you may qualify for a loan if you're under that 45% threshold, but you know, you don't want too much of your money that's coming in to go towards debts, but you don't have enough to kind of pay for daily living expenses. So
We try to just find a healthy balance, which is, like Tony said, why we have a risk tolerance, but we also work case by case, so we can kind of talk to you about your own personal situation and help you make the best decision. We absolutely will set up appointments to meet with you, you know, whenever works for you. We'll talk through what's going on. We'll find the best scenario, the best case scenario. We don't want to just give you loans without you knowing what they are, how to pay them, or anything like that. We want to work with you and figure out the best situation to help, you know, your financial history get better.
absolutely.
Very good.
So now we're going to discuss debt consolidation. So what is that? That's the process of rolling multiple debts into a single payment. And you can benefit if you know that you'll basically qualify for a low enough interest rate. So to give you an example, let's think about maybe you have student loans, right? We kind of discussed those earlier. You have some public and some private, or you have all public and you want to just consolidate your public ones. You may be getting some at a fixed rate, you may have some that are variable. If you know when you basically consolidate, you can get a lower rate, well, that's going to make managing and paying down debts a whole lot easier. So consolidation is one strategy to helping you pretty much manage your finances. So how do you consolidate your debt? So there's different options out there, and one is getting a 0% interest balance transfer credit card. So that's one strategy. So for example, let's just say you have 4 credit cards, maybe one with a balance of $1,000, another with a balance of $3,000, and you really want to help kind of knock down that debt. Doing a balance transfer to a card that offers balance transfers will help you take it. You know, you can take advantage of this 0%. Sometimes some cards will offer 6 months 0%. Some cards will do 18 months, sometimes 24. I personally recommend to use those type of credit cards, not as another way to pay for more goods, but to even just put that card in a drawer and just say, I'm going to utilize this as a loan, a 0% loan to pay down this debt. So I love that as a strategy when it helps to kind of minimize your overall monthly obligations. So when I say don't try to snowball more debt on that, your overall goal is to basically take advantage of that time period and say, try to make an educated guess based off your financial standing. Can I pay off this debt within 18 months if I bring it down to 0%? You know, it can be more challenging when you have a high interest rate and a high balance on a lot of cards to kind of keep up with just monthly minimum payments. But if you start throwing large payments towards a credit card at 0%, it's going to make it a little more manageable for you to kind of get out of that hole. Or the second option would be to get a fixed rate debt consolidation loan. So sometimes that can be in the form of a personal loan that you can be using for debt consolidation. If you know you have 4 credit cards with really high interest rates, but you can get a personal loan, right, at 12.5% or 10%, it almost seems like a no-brainer. So when debt consolidation is a smart move, so obviously there's strategies, right? So your goal is to overall make sure you can qualify, but there's certain things you should try to do to position yourself so you can qualify. And one thing is that your total debt, excluding your mortgage, doesn't exceed 40% of your gross income. So I kind of mentioned this earlier. You know, obviously you may qualify for a home, right? If you kind of fall under a certain threshold in terms of DTI, but if you're now struggling to pay for groceries and now you're struggling to pay for X, Y, and Z, you did qualify for the loan, but are you still managing your debt well? So always keep that in mind. Sometimes just because you do qualify for something doesn't mean you should necessarily inherit that debt, right? So keeping that low is really important. And second there is your credit good enough to qualify for the 0% credit card, for example, right? If you do have, let's just say, 480, you might even not even have the opportunity to do a debt consolidation loan. So these are more of your strategy. You should try to be proactive and not reactive. So where you're kind of in the fire, you want to do these things before you kind of get there. And these are active strategies you should take. Third, your cash flow it consistently covers payments towards your debt. So that's really important. If you have one source of income and that's your job, great. Sometimes that's in today's world, it can be a little bit of a challenge when you just don't have enough money coming in. So finding a second source of income, maybe a second job. Sometimes I'm encouraging people to start a side hustle. Maybe find investments that pay a dividend. Going out there and taking action and doing something to earn a second form of income, or even help yourself, right? Get some education, find a new skill, see how you can add value in the workplace. Hopefully you can get a raise and a promotion, right? That doesn't give you another form of cash flow, but it will overall raise your level of income if you do get a promotion at work usually. So do whatever you can there to help you get more money to pay down your debts. And then lastly, you have a plan to prevent running up the debt again. So if you're already kind of in a hole, a lot of people don't want to fall deeper into that hole. They really most people want to turn it around. So trying to give yourself maybe a 1 to 5 year plan, depending on your level of debt, of course. So have a strategy. Say, try to have a goal for yourself. You say, okay, I really want to pay off these debts now. I know I have my biggest goal is to pay off the mortgage, for example. But if you have credit card debts, try to focus on trying to pay down the credit cards with the highest interest rate if you don't qualify for some sort of consolidation loan. So have a plan going into this, and that's really important. So debt consolidation. Is it a good idea to consolidate credit cards? We kind of discussed that. So my thing is always consider, are the terms in your favor, right? So we did discuss a credit card, for example, 0% for 18 months. Do you know, or do you think, I should say, you'll be able to pay off all that debt within 18 months, knowing the fact that interest rate might go anywhere from 22 or 25%? Try to have a game plan. If you know you don't have enough money coming in, does it make sense to do? You don't want to pigeonhole yourself to a larger monthly obligation. We already kind of went over how does debt consolidation with the loan work, so I'm going to skip over that. Does debt consolidation loans hurt your credit? So typically when you apply for any type of credit, there will be a temporary drop in your credit score, and they call those hard inquiries. However, as long as you start making on-time payments over a short period of time, you'll start to see your credit score start to move back up. So it's all about being responsible. So it's a temporary increase that will help you hopefully you qualify, and again, you're making the right choices, you're paying down your debts as much as possible, and it's going to overall help boost your credit score.
That's it. Things might get a little bit worse before they get better.
Yeah.
If we have that real quick drop in your debt consolidation, if you take out, a consolidation loan, even that little tiny drop in credit will help you in the long run if you're able to pay that debt off.
Yeah, absolutely. And when is it not worth consolidating your debt? So when the terms are just generally not in your favor, as I mentioned. When the terms are, do it. When they're not, don't do it. If you know you're only going to save maybe $30 a month, but now your monthly payment is now going to be due at the first of the month, and you don't get paid until the end of the month if you get paid monthly or you get paid bi-weekly, that's something you're going to have to consider. Keep that in mind, right? Everybody gets paid differently. Some people have sources of income that are not static, right? There's some people who make commission-based income, right? They might make $1,000, they might make $1,500, they might make $2,200. Another month they're making $4,000, $6,000. Maybe they're making only $700. So you really have to have a holistic view of what's going to make sense when it comes to trying to minimize your overall debt pad. And then what happens if your debt has gotten out of control and your credit took a hit? Are there still options? And the answer is yes, there are still options. One that you kind of see up there is cut up those credit cards. Stop adding to the debt pile. This really comes down to taking ownership. Sometimes you just got to you got to really do whatever it takes to change a bad spending habit, and you got to really take ownership.
Determined.
Yeah, you got to be determined that you see the light at the end of the tunnel, and you're going to do your best daily and monthly to kind of overall try to minimize your monthly expenses. You know, sometimes it may not make sense to take the family out to dinner every single night or to go on vacation every summer or things like that, but trying to cut out and shift from wants to needs. And then when you have that available to you, obviously do it and budget accordingly, but have a strategy. You know, I always say it's making money is easy, but keeping it is the hard part. I think for all of us, right? And obviously we all know how inflation's had an impact, right, when it comes to spending money and our spending behaviors. So we all know how I say when it comes to buying groceries is a little more challenging. So secondly, find a way to increase your income. I kind of already went over that. You know, go ahead and try to, get a second job, side hustle, do anything you can to increase your source of income. Combine your income if you're married. Do things that make sense. Start making on-time payments. Obviously, if you had a history of not paying on time, do your best to kind of change that. Prioritize those debts because eventually it may be unattainable. Lastly, if you can, pay extra each month to help you get out of your debt. I always say as I mentioned, tackle that high interest rate debt first, because that high interest rate can make growing debt, make it grow exponentially. So always keep in mind, try to tackle the highest debt first. That's just my opinion.
Yeah, summing those right up, there's two ways to get out of debt. Either increase your income or lower your expenses.
Yeah.
You can only lower your expenses so far. So a lot of times if we can get those right down to as low as we can, sometimes increasing your income is the only other way to get out of that debt.
Yeah. And like I said, ultimately it's gonna be a change in philosophy in the way you carry yourself and say, hey, as much as I love to treat myself to this type of activity or this type of thing, you maybe cut back this month and do it every other month. Or like I said, it's the same way a bodybuilder is disciplined to do certain things every day that eventually that shows in their fitness, right? And it's the same thing with your own financial wellness, right? If you do the things correctly daily, it's going to show and you'll have more money to spend, whether it be paying down debts or just more money to kind of save for emergencies.
Free money.
Free money, right?
Free money. You really need to break it down to exactly what you have to spend on your expenses every month and then set up an automatic transfer, into your savings account and say, all right, this $300 a month I'm gonna save, and now it's not in your checking account. Now it's not there for you to spend. It's almost taking your brain out of the equation and just making it automatic. If you don't see it in there, you don't spend it. Sometimes that's a good habit to get into.
Yeah, absolutely. So, try to set yourself up for success. I've seen folks that don't track anything, right? They don't use a register, they don't use an Excel sheet, they don't use online banking. Use the resources you have available just for your basic checking account. Know where your account is standing every day.
Yeah.
Check the things that come out. Not only can you check to see if something potentially came out that was fraudulent, but you'll get a general understanding every day what you have in your checking, your savings, what your current loans are. Just being aware is great. And like I said, set up things that you think you may forget up as automatic payments to help you kind of manage that. And this is our final slide. So any other questions you may have, whether it's about general credit or even debt to income ratio or debt consolidation.
When you're doing a debt consolidation, if you get an offer for a low APR for the life of the balance, I've seen it done. I've done it a couple of times, but it seems like it's less common now than it used to be.
It is a little bit less common, especially as times have changed and of course there's some corporate greed going on. So depending on where you're weird, right? So depending on where you're applying, the institutions want to make money as well. That does happen. What typically changes though is the terms of the loan. So they might be giving you a lower rate but telling you to pay it off in a year and a half. So your monthly payments are going to skyrocket. Even though you have a much, if you have a $10,000 loan, it might not be that difficult to pay off over 5 years. But if you're trying to pay it off in 2 years, those monthly payments are going to be a lot higher, and that's where they're going to get you. Anything else?
Any other questions you may have?
Yeah. Credit is a funny thing, but I will say the things you do in the short term will make things that you do in the long term easier. So if you do need to do those balance transfers, taking out another credit card might hurt you in the short term, but it'll benefit you in the long term if you can get that paid down. Likewise, if you have 7 credit cards and they all have balances, pay them off. Close 4 of those cards. It will impact you in the short term closing those 4 cards, but if it means that you can spend responsibly with only 3 cards, that's going to benefit you in the long run. You're really going to raise that score. So I would say, Tony and I have seen a lot of cases, but I would say if you're dedicated, most times we can get debts paid down in 2 to 3 years, and that credit score it'll go up the entire time you're doing it. If you're dedicated to it. It doesn't wait until the very end of the payments to raise, it'll start raising throughout the process. We also brought our business cards if you guys want to take those. If you have any questions that you want to email us or call us privately or directly, you're more than welcome.
Yeah.
Both of our phone numbers are on there, as well as both of our emails as well. Our extensions too, our direct extensions. Thank you guys for
Thank you.
coming out.
I appreciate it. Thank you so much.
Yeah.
Well, too bad it's not a whole crowd.
I know.
Thank you guys. I appreciate it.